Are you looking to become a better real estate investor? Then hang on, because you're about to experience another episode of the world's most popular real estate podcast, the BiggerPockets Podcast. But before we get to this week's show, I wanted to invite you to become part of our community, BiggerPockets.com, the real estate investing social network. The membership is free, and you'll instantly gain access to networking opportunities, educational content, investor tools, and more. Sign up now and get a free copy of our book, The Ultimate Beginner's Guide to Real Estate Investing, read by hundreds of thousands of budding entrepreneurs. Just click this link right here or just head to BiggerPockets.com. With that, let's get to the show.
You're listening to Bigger Pockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
Hey everybody, this is Josh Dorkin with BiggerPockets.com, here with yet another great show for you. I've got my co-host Brandon Turner with me. Hey Brandon.
Hey Josh, how's it going?
Not too bad, not too bad. Of course, today we're very excited to bring to you one of the greats in the business, a guy named Frank Gallinelli. Don't know if you guys have heard of him, but Frank is definitely one of the he's one of the smarter kids on the block, so to speak. Frank's founder and CEO of Real Data, created it back in 1981 before most of us were born. Providing the company provides analysis and presentation software for investors and developers. Frank is also the author of 3 books: Mastering Real Estate Investment, What Every Real Estate Investor Needs to Know About Cash Flow, and 36 Other Key Financial Measures, and, mouthful, Insider Secrets to Financing Your Real Estate Investments, What Every Real Estate Investor Needs to Know About Finding and Financing Your Next Deal. Frank is also the author of a ebook, which happens to be a free ebook. You can pick it up right now on Amazon.com. 10 Commandments for Real Estate Investors. For all these books, you guys can find on our show notes at BiggerPockets.com/show4. Frank is a really good guy. He actually taught back at the BiggerPockets Summit last year and got great reviews. He's a graduate of Yale University. He serves as adjunct assistant professor in Columbia University's Master of Science in Real Estate Development program for developers. And we are very excited to have him here. Frank Gallinelli, what's going on, man? Welcome aboard.
Hey, Josh and Brandon. Great to be with you today.
Good to have you. Good to have you. That was quite a mouthful, man. You got 3 books with really long titles.
Yeah, well, I didn't write the titles of some of those. It was my publisher who did a few of those titles. I wanted to write something called, Sex, Lies, and Real Estate, but they just wouldn't. So we got what we got.
You're a bestseller with what you got, and had you gone with the Sex, Lies, and Real Estate, you might have sold a couple more.
Well, they've sold more than 80,000 copies of one of those books, so I guess I really shouldn't complain. Maybe they knew what they were doing. I'll give them credit for that.
Wow, 80,000 copies. That's pretty substantial. So does that give you a big head? Do you feel you're a big shot?
Well, not really. I do go into bookstores occasionally and volunteer to sign a copy of my book if they have it on the shelf, and they always let me do that. And then I always say, "Oh, by the way, I also wrote Hamlet. Can I sign that as well?" Because they never check to see. So apparently, I'm anonymous to the entire world. They don't know who I am. I could be Shakespeare for all they knew. It wouldn't make any difference.
I could see you standing in the aisles of the bookstore, waiting for somebody to pick up a copy of your book and just watching them.
I'll catch you. I'll put that on YouTube when I get a chance.
Well, so we are here today to talk about income properties, and you've been teaching and writing and working in that space for a long time, and I guess we'll kick this thing off with residential versus commercial. Which do I want to think about as a new real estate investor? What do you think?
Well, I get that question quite a lot, Josh, and there's really not a right answer to that question, but there's probably a best answer for a particular individual. One of the things that I've always seen is that most new investors, because they've lived in a house or lived in an apartment, that situation is a little bit more comfortable. It's a little bit more familiar, so they tend to gravitate toward that. The residential type of income property. The one thing I might be a little bit cautious about is if you're getting into that, watching out for getting into something that's too small. If you're looking at property that's 4 units or less, you're probably looking at property that's intended for somebody to live in rather than really an investment. So I advise people that if they're going to go with residential property, look at something a little bit larger. Look at the 5 units or bigger. When you get down to making that basic decision, though, between residential and commercial, there's a lot of things to think about. Some of them are global, some of them are local.
Okay. So let's talk about that, because I'd say for the vast majority of folks on BiggerPockets, for example, and a lot of newbies that I've come across over the years, they hear commercial, they hear 5+, and they start breaking down into cold sweats. So, what is it about these multifamilies that people need to know and not worry about? What are the big fears that people have, and how can they overcome those fears in thinking about these properties?
Well, if it's a residential property, it's really in terms of its character, it's not a whole lot different from the 2-4 family, except that when you're trying to assess what the property might be worth in terms of a purchase price, you have a lot more concrete information to work with, because you're going to be valuing that property the same way the bank is valuing the property, and that's based on its income stream. When you get into smaller properties, the 1, the 2, the multiplexes, that kind of thing, the value really is determined by forces that are outside your control. You're looking at general economic forces that cause house values to rise and fall, which means you don't really have one of the big advantages of owning real estate as a long-term investment. You don't have the ability to create value yourself. People don't buy a single-family house or even a duplex for its ability to produce income. They buy it as a place to live, and maybe they get some income besides. But people buy the larger properties, the 5 and greater, for their ability to produce income. And in 40 years of dealing with real estate investors, and 10 years of dealing with grad students who are learning this sort of thing, I think I find the one issue that they have the hardest time kind of wrapping their head around is the notion that a property, if it's an investment property, if it's an income producing property, a true income producing property, its value is based on its income stream and not on comparable sales.
Gotcha. Okay, so let's get into that, because I think that's at the crux of what's going on here. Comps, as we know, are valuations determined based upon prices of properties in and around the area of similar type and style, I guess, so to speak. And income property, as per your definition, is going to be a property that we're going to evaluate based solely upon that income stream, correct?
Absolutely. And that's if once you can really internalize that concept, you're halfway to mastering the fine art of income property investing. Because, everybody thinks, for example, location is important. Well, when you're buying a single family house, location is critically important, because the value of that house is going to rise and fall the way the value of your neighbor's houses rises and falls. Okay? When you're buying an income property, you have to look at it through the prism of its income stream. Yeah, location is important. But why is it important? Because good locations can probably generate a greater and more reliable income stream than dicey locations. Okay? Everything really comes down to the income stream. You're going to buy that property not as a place to live in. You're going to buy it for its ability to produce income. I mean, you don't buy a stock because you like the stock certificate, okay, because it's pretty. Okay? You don't buy an income property because it's a pretty building. The fact that it's a pretty building may contribute to its ability to produce income. People like to rent nice-looking buildings as opposed to ugly buildings. But what it really comes down to is the income stream.
Yeah, that makes a lot of sense. I know when I bought my apartment complex, a lot of people thought, they gave me a lot of a hard time for buying one that was in kind of not a rough location, but it wasn't, amazing. And everyone always says location. But, I could just point to the income that the property was producing and saying, well, this is why, this matters more to me than location. I mean, I'm not saying I would go and buy something that's in the ghetto where I'm going to worry about getting shot, but just the fact that the income was there, that tipped me in the way of buying it and not just passing on it like everyone else seemed to have been at the time.
Yeah, absolutely. An example I give students each year when I teach this at Columbia is two properties that are right next door to each other, but one has normal leases that are going to escalate over time and where there are options and so on, and the other one right next door, a virtually identical building, is locked in to really below market leases and locked in over time. Now, physical location, everything about them physically is virtually identical. It's the leases and hence the future income stream that's different. So one is more valuable and a better investment than the other, even though they're physically is the same.
Gotcha. All right, so let's talk about that. The valuation of a property is determined based on that income stream. So how would somebody determine the value of a property? So you've got these two properties next to each other. One of the properties is deriving X dollars in income, and the other property, which is virtually identical, is bringing in, say, 60% of X in terms of that income stream. We can then say that the property that is bringing in X is worth a lot more today than that other property, correct?
Yeah, and actually you just hit on a very key point here when you said today, because there's really two issues going on when you evaluate potential income property investment. And that is, how is it going to be valued today? And what do I think of it as an investment? Things don't always mesh perfectly, which is why you really have to be careful in how you look at these things. With the value today, it's a pretty standard approach, the same as your appraiser would do. Okay, you're going to take your gross income, you're going to subtract vacancy loss, you're going to subtract operating expenses, come up with a net operating income, apply a capitalization rate that you found out is appropriate by going out and talking to some commercial appraisers, and you're going to come up with a value. Now, where you can run off the rails on doing that, and where I've seen people get this wrong, is that they don't really understand the definitions of those various terms that I just used. They don't really know what is an operating expense and what isn't. And it's important because if you don't follow the same set of definitions as everybody else doing this sort of thing, then you don't come up with a value that squares with what a lender is going to come up with, or what other investors are coming up with. So that's one big issue when you're looking at just the current value of property.
Gotcha. Okay, and that's probably, would you say that determining the value that a potential lender is going to be square with, I would assume then that would be probably one of your most important jobs as the owner of these properties, or potential owner of one of these properties, is to say, this thing is worth X. We know it's worth X. Anybody else, there's not going to be any questions. An appraiser, there's no, the bank, the potential buyers, everybody's going to be in complete agreement that the value of this property today is absolute. Is that true?
Well, there are no absolutes in anything, and least of all in real estate. But you at least have a reasonable estimate of what the value is when you take this approach. But it's important for a number of reasons. And one is the fact that you're probably going to be looking for financing on this deal. And if you're looking for financing, you're going to have to be able to have a good understanding of what that property is worth, an understanding that squares with what the bank's appraiser is saying. Okay, you may need an equity partner in order to do the deal. Once again, you need to be able to show the equity partner that you've got your ducks in a row, that you understand what the property is worth. So you do want to come up with a reasonable estimate of value. Is there some give in those kinds of estimates? Of course, because they're based on what's going on in a marketplace today, and in terms of capitalization rates that other investors are using. And when you look at those sorts of things, when you get that kind of information from an appraiser, the appraiser will tell you, well, probably 8, maybe 8.5, and so you develop a range for what is a value that you can live with that property. But then got to go to that next step that I talked about and look at, does it really work for you as an investment property?
Gotcha. So you ran off a couple terms, and I just want to remind everybody listening that we're going to actually have these terms and definitions posted in the show notes, and that'll be at biggerpockets.com/show4. It's biggerpockets.com/show4. That you just mentioned equity partners, Frank.
Yeah.
Let's talk about that a little bit. You're now talking specifically about the financing of a potential purchase, correct?
It can be very important to have an equity partner in certain circumstances. The conventional wisdom about real estate investing has been, well, it's great to use other people's money. Invest as little cash as your own as you possibly can, and finance as much as you can when you buy an income property. That can be a good approach in certain circumstances, but can also be a dangerous approach in other circumstances. For example, in the kind of economy that we've looked at over the last 4 or 5 years, where financing has been very difficult to get, it would have been impossible for you to get the financing that you need if you didn't have equity partners. And if you did get it, it would be on terms that would be so onerous that it would eat up your cash flow. And in more normal economic times, still leveraging up your purchase to the hilt means that you have a lot of debt service, and when you don't have any skin in the game, chances are your financing is going to be more expensive than if you were looking at a lower percentage of the purchase price that you needed to finance. So what I generally tell people who are dealing with this issue is, for example, they say, well, I want to have the whole deal to myself. I don't want to share it with equity partners. And I say, well, listen, would you rather have 100% of a negative cash flow? Or would you rather have 50% of a positive cash flow? Because if you're financing it up too much and you're getting poor terms because you're doing that, and you're having enormous debt service because you're doing that, you're minimizing your chances of having a positive cash flow. So maybe it's better for you to share that purchase with some equity investors, and maybe just as a side benefit, you might learn something from one of those equity partners because you'll be bringing another person in who may in fact have more experience than you do.
I couldn't agree more, Frank. People give me, they ask me why I use partners a lot. I use a lot of partners when I buy and sell real estate, and this is commercial or residential. And I always tell people, well, I'd rather have 50% of a good deal than have 100% of no deal. And people, I don't know. I have a lot of people that say, well, I wouldn't have done that with a partner. I would have just done it by myself. But when I started out just trying to do things by myself, sometimes it worked great, and sometimes it didn't work out so great. And so I love going the partnership route just because of that. But I think, like you said, sometimes it can be dangerous. You just got to be careful when you're doing it. So I'd actually love to go back to something you mentioned earlier, Frank. We're talking about increasing the value of property, and I know that's one of the things I absolutely love about commercial property is that on a residential, if you want to increase the value, you talked about this earlier. There's not a whole lot you can do other than make it look pretty and make it look like the other ones. But the thing I love about commercial is that you can find ways to add income, and that's going to add value, and it adds it at kind of a I don't know what the word is, like exponential rate. Like if you can increase your rent $500 a month overall, that's going to increase the total value by, possibly tens of thousands of dollars, just instantly. And so a good way, I've seen that is when you can find a property with rent that's undervalued. If typical rent is in the area is $500 per unit, and you find one that everyone's at $400, and you can easily raise it up to $500, you can jump the value leaps and bounds overnight.
You're absolutely correct. And since the property's value is based on its income stream, when you raise that income stream, you by definition raise its value. Let me give you though a kind of an example that is intuitive. We'll go back to even to residential as well as to commercial. With one of the advantages of residential is you have short leases, so you have a lot of turnover. And so you do have an opportunity with residential or with mixed use, a combination of residential and commercial, to work on building those rents up. One of the things that's kind of counterintuitive is that you'll take a look at a piece of property, and you'll see that it has low vacancy rate. Okay, not too many vacancies currently, not too many vacancies in the history. And you say, well, that's a good thing because I don't want vacancies. I want to collect all my rent. One of the things that tell you, however, is that the vacancy is low because the rents are below market.
Yep.
So even not that tuned in to exactly what the rents are in that market, a low vacancy history on a particular property could be a tip-off that you have below market rents. And then your plan at that point is, I want to buy this property based on its current income stream, because you're not going to accept the argument from someone selling you the property that you should pay for what it could be.
Yep.
You want to pay for what it is. So you want to buy that property based on a current income stream, but you know in the back of your mind that zero vacancy rate, when everybody else in the marketplace may be experiencing a 4% vacancy rate, that the zero interest vacancy rate on this property is your clue that here is an unusual opportunity. You can go right in there now, and with short turnovers, especially on residential leases, that you can raise that value.
And the other side of that coin is not just raising income also. Would you agree, like, decreasing expenses is also a huge way to improve the value as well?
Oh, absolutely. You're absolutely right on that. The euphemism I use is management improvements. Very often people simply don't pay attention to what something is costing. They don't shop there. I mean, you can't shop property taxes, that's for sure. But you can but you can keep an eye on every time you get a reassessment. I have successfully gone in and talked to the assessor after a reassessment, and I said, how did you come up with this? And had him say right back, "Ooh, look at that! They used the wrong cap when they made your assessment. You're right. We're going to lower your assessment." I didn't get an argument. It's just that I looked at the NOI of my property. I looked at what I knew was the prevailing cap rate. This was a commercial property. I looked at what I knew was the prevailing cap rate for properties like that. I went into the assessor and says, A divided by B doesn't equal what I've got on my assessment. He says, "Yeah, you're right."
I need to try that.
Yeah,
Yeah, sounds great.
The wrong assessment. Same thing with property management. Do you do it yourself or do you farm it out? There's an opportunity there sometimes to save some expense there.
So actually, Frank, I have a question about that property management stuff. Something I'm curious about for my own investment, and I know I've seen it on BiggerPockets quite a bit. It's that, the value of a property is based on the NOI, which we talked about, the net operating income. And obviously, a way to decrease your expenses is to not have property management. So what I'm wondering is, what do you think if a person doesn't have property management, then that makes the value of their property much higher, right? Or do you include what it would normally cost for property management? So how does that work exactly?
I think it's not really an enormous difference in the value of the property. A typical property management expense would probably be a couple percent of the gross operating income. So there would be some difference, but I don't think it would be an enormous difference. Many appraisers might indeed plug in a default number for the value of property management. So there's a possibility that they too would decrease the NOI slightly by the value of the property management expense that's not really being taken into account. In terms of whether you should use a property manager or do it yourself, that's another one of those jump ball type of questions. If this is residential property and you feel fairly comfortable doing it, that's okay. However, when you get into a lot of properties, or perhaps when you get into commercial property where there's a lot of dealings with leasing, for example, and other issues, then it may be prudent to use a professional property manager. What this does bring up, however, is another kind of interesting question about understanding your own particular investment objectives and preferences.
Yeah.
This is a question that comes up a lot when we talk in Columbia in my classes. As a matter of fact, I've now built one of my case studies for my students that goes right to the heart of this subject, and I give them a choice between a mixed use property and a standalone retail, such as a standalone pharmacy. And it's kind of an interesting conversation that we have, because the mixed-use property is one that gives the hands-on investor a lot of opportunity to enhance that cash flow and therefore to enhance the value. On the other hand, the triple net lease property doesn't do that. And so the question I ask my students, and I tell them right off the bat, there is not a right answer to this question, is which one of these properties would you prefer to purchase and why?
Gotcha.
Let's actually talk real quick about you mentioned triple net lease. What exactly is that for those who don't know?
Okay, triple net lease is where basically the investor has very little personally to do with operating the property and very little to have to pay. A triple net lease occurs with commercial tenants, and it's where the commercial tenant will pay either all of the increase over a base of certain operating expenses. Let me be more specific. You rent to that freestanding pharmacy that I was talking about, and as part of their rent, we call it additional rent, they will reimburse you, the landlord, for the property taxes, the property insurance. If there are any utilities involved, such as water that might be getting billed to you, the landlord, they would reimburse for that. They would do all their own maintenance and repairs. They would basically do everything. The only thing you would do would be to open the envelope where the rent check comes in. And the rent check would include these extra amounts to cover those expenses. You wouldn't ever let them pay those expenses directly, because you wouldn't want to be relying on a third party to pay your property taxes or your property insurance on time. So they reimburse you. These things are really called expense reimbursements. But in a triple net lease situation like that, there is no property management expense very often, because there's very little for the property manager to do. Also typical of that kind of situation is that your anticipated return on your investment is lower. Okay? If you're getting into that mixed-use property that I was describing, where you're hands-on and you're dealing with tenants that are turning over frequently and so on, you expect a higher return because there's more risk, more uncertainty. That commercial lease, that triple net lease I was just talking about, is 5 to 10 years. Everything's predefined. You're not at risk for increase in property taxes because they're reimbursing you. You're not at risk for maintenance expense because they're doing it. So it's two different situations. So the interesting conversation that comes up in our students is, which would you prefer and why?
Well, I was going to ask on the triple net, other than the lower the lower income, what's the downside? I think people are going to sit here, listen, and say, "Wow, triple net lease sounds awesome. I could go buy a property, not have to worry about any of these details." And okay, so maybe it'll pay me a little bit less income. What are we talking about here in terms of that? What is a little bit less in terms of percentages, and what are the other negatives that come with the triple net lease, other than perhaps being stuck with somebody for 5-10 years that maybe you don't love personally?
That is that is certainly one of the possibilities. But even if you love them dearly, you're still stuck with them 5, 10, even 20 years. And what that means is that if you negotiated a lease where the rent goes up on average 1% a year, you might not actually raise it every year. It might be every 3 years, every 5 years, whatever. But you may have locked yourself into a 10 or 5 or a 10 or a 20-year deal, where suddenly you find yourself in a tremendously hot market, where if you had been renting these things, if you've been renting the space more frequently, you could have done significantly better than that. Other issue, of course, is that if and when you do come upon a vacancy, it may take you a good deal longer to re-rent a property like that than it would, for example, if you're renting apartments in a 40-unit apartment building. Everyone has to live somewhere, pretty much. So demand for apartments is a kind of almost a universal constant, that there's, you can always hope to find a tenant for an apartment. If you've got a 10,000 square foot freestanding former pharmacy, your issues in terms of finding a replacement tenant overnight are obviously considerably greater. So you have that kind of risk in terms of the rollover of a property like that. That would be greater. Um, one of the issues that I talk to my students about, I said, I'm a lot older than you, so maybe I haven't got quite as much energy and desire to set the world on fire that as you do. So maybe you want to buy that mixed use property, spend all your nights and weekends. Okay, commercial tenants, are commercial tenants. But residential tenants don't keep business hours. So if the toilet clogs up at 3 o'clock in the morning, you're going to get a call. You've got to be willing to be, for that home run kind of return, be willing to roll up your sleeves and kind of be 24/7 as a real estate investor. You get to be someone who's a little bit longer in the tooth, such as myself. Oh, no comments now, Joshua. Maybe what I prefer is the lower return, but more predictable return, and the more predictable lifestyle that comes from not having to deal with the property on a daily basis.
So I think that goes back to what you said earlier, where there isn't necessarily a right or wrong answer, but there is a best answer for each person. And so it definitely, the triple net lease commercial lower rate doesn't necessarily entice me right now when I think about it, because I like getting my hands a little dirty, and I like going out there and working and find ways to leverage my skills and ability to try to get more return. Where I can definitely, in 10 years from now, I hope I'm not still doing that. But
and it gets back to a subject again that I probably kill a half lecture on when I'm teaching. It's the subject of clarity, and I say you not only have to be clear in terms of what you are trying to convey to other people in a transaction, but you have to be clear in your own mind. You have to be clear as to what it is that you want. What are you doing this for? Okay, are you doing it because you're trying to hit? You're trying to hit home run, and you're trying to ultimately live off your success as a real estate investor? Are you doing it for long-term security? Are you doing it to put your kids through college? You have to be clear in terms of your own objectives before you can decide what road you're going to take on these investments.
Gotcha. I want to jump to these deals and opportunities. Where can somebody find these income streams? Where can somebody go and find these deals? And I'm talking outside of, say, for example, a LoopNet or one of the traditional commercial broker sites online. Are you going to go and find a good deal from just calling a commercial real estate broker, or do you need to know somebody? How does somebody find a good deal?
Commercial real estate broker can be a very valuable asset. So I wouldn't dismiss that idea by any means. One of the things that I've always felt strongly about, and I think I even discussed this in my little 10 Commandments book there, is operating locally. I know a lot of real estate investors, they try to chase the latest hot market. I recall once I was giving a talk out in this was in the late 90s. I'm giving a talk out in Los Angeles and San Diego, and nobody wanted to talk about what I came here to talk about. They all wanted to know if I knew where the best places in Las Vegas were to buy properties. I said, I wouldn't know Las Vegas if you dropped me, in the middle of it, out of a helicopter. I say if you can become expert in your local area, then you'll really know where the cracks in the sidewalk are. Okay. And brokers can help you, but when it comes to commercial property in particular, essentially every building is for sale, whether it's for sale or not. So if you see something that you think has promise, there's no reason. It's not like walking up to somebody's house and saying, "Hi, I really like your house. Would you mind moving out?" Okay. If you essentially make that same proposition to someone who owns a strip shopping center, or that retail that's freestanding pharmacy they talked about, or the 40-unit apartment building, they'll say, "Well, let's have lunch and we can talk about it. We can see what I'll be happy to with the proper non-disclosure. I'll show you my rent and expenses and so on, and we can talk." So becoming expert in a local area where you really know everything that's going down, and there's a side benefit to that. You not only know the properties, but you also know the the local politics. You also know the local budgetary process. You know, for example, if you've suddenly now got a mayor who wants to, to spend you into oblivion, and your property taxes are likely to be going up, you really have a sense of how things are going on, going along.
I think you nailed it right there with knowing your market. That's one of those things that I hear all these new investors coming in, and particularly in the residential side, who say, what market should I invest in? Where should I go? And it always goes back to, guys, you need to know where you're at. You need to know your market. Pick one, focus on it, get to know it. If you're doing houses, walk every block in your market, know every house that's for sale, go to every open house, go to, check out these listings until you know it cold. Because when a new house pops up on the market, you know that value. You don't even have to go and run the numbers. You can look at it and you can, you can figure it out pretty quickly. I would assume on the commercial side, we're talking about the same thing. Obviously, it might take a little longer, but by being familiar with your market, you become an expert. Whereas, by flip-flopping around and jumping all over the country and different parts of your area, for example, you may not necessarily know the different goings-ons. Is that a word? Yeah. Goings-ons?
Yeah, that's like attorneys general. Not become an expert, but you become a known entity, a known quantity, so that when you're going for financing, they've seen you here before because you've done deals locally. Other property owners who might be thinking of selling their buildings know that you've been buying this kind or that kind. And so when they think of somebody to call, maybe before they call their broker, they may call you.
So, Frank, do you see that, I guess, commercial real estate is a little more stable nationwide? And what I mean by that is, I probably wouldn't want to go invest in an income property, like a residential income property in Los Angeles or in Seattle or New York City, because the prices are so high it's really difficult to make a return. Do you find commercial is like that as well? There's hot spots where it just doesn't make sense to invest, or is it pretty stable nationwide?
The commercial property is always, as I said, is typically a function of whatever is the prevailing cap rate, whatever is the prevailing rate of return that other investors are willing to accept. And yes, there are markets where you have to ask yourself, what are these people thinking? When they're something at a cap rate of 4%, which means cap rate runs in the opposite from value. So as cap rates go down, values go up. So you'll find areas where the investors are buying at such high prices. You have to wonder how they can make a return. Like everything else, I think there are inflated markets, commercial or residential. So you have to be conscious of that. And once again, I think if you're trying to do this and you're sticking locally, you have a much better chance of having a real sense of what is appropriate for the market that you're dealing in, because you'll be seeing properties being bought and sold all around you if you stick within a relatively modest radius. And so you'll know that when somebody has paid a price that doesn't seem to make sense to you, that maybe that shouldn't be your bellwether. That shouldn't be your cue to, okay, now he paid 4% cap rate where everybody else is paying 8%. Which one do I want to believe? He may be, that may be an aberration. And you can spot an aberration, I think, more easily when you're dealing in a restricted area.
And when somebody's starting out, what do they need to do? We're talking about all these different things here, and I think a lot of folks listening again are saying, well, I'm new to real estate. How on earth do I get involved in commercial? If I want to buy a house and flip it, I could buy a house and flip it. If I want to be a landlord at a house, great. What do I need to do to get my ducks in a row? Do I need to put together a presentation material? Do I need some kind of package, to go out there and convince a lender perhaps to lend me money? Where do I find the properties? What do I need to do to set myself up to be this budding commercial real estate investor?
That's a great question, Josh, and it's really, in an attempt to answer that question, that's why I've been teaching for the last decade, because basically, people go into this and they don't know where to start. They don't know they don't know what they don't know. So my advice invariably is that you have to start with a bit of education before you actually try to do something. You have to understand what it is you're doing. And so I urge people in the strongest possible terms to know the vocabulary of this business. Okay? To know what the terminology means, because not only is it necessary in order for you to be able to make a sensible analysis of a property, but it's also necessary for you to have any reasonable credibility. If you don't get your terms right, you're just not going to make any headway at all as a real estate investor, especially in commercial real estate.
Not to sound like a suck up here, Frank, but your book, actually, the 36 other key financial measures, that was the book that taught me almost every real estate term, like the important things like cap rate. I actually checked that out from the library when I was first beginning, and that was really helpful. So this is kind of cool. I never actually thought I would get to say thank you to the author of that, but thank you.
Well, thank God. I'm right now autographing my computer monitor for you.
Nice.
And yes, you are a suck up, Brandon.
Yes.
That's why I wrote that book, because the typical real estate investor goes into this, starts off in this, doesn't know the difference between, what is an operating expense and what is not an operating expense. What does net operating income really mean? What are these different terms? And so when they go to try to do a deal, they're inexperienced. They might be wearing a sandwich board saying, I am a newbie, take it. When they go into the bank, if they don't know what a debt coverage ratio is and they haven't done their analysis, the lender there is going to look at them and say, why are you wasting my time? And if I ever see you walk through that door again, I'm going to tell my secretary I'm busy. Okay. There's someone who doesn't do the analysis, for example, and tries to go into a lender when the analysis would have shown that their debt coverage ratio is 1.0, which means they just barely can pay the mortgage if nothing ever goes wrong. Well, if they had done their analysis, they would have known that they're not getting the loan on those terms. So by walking in there, they haven't accomplished anything. They're still not getting the loan, but they have proven to this lender that they don't know what they're doing. So starting off with the basic education, getting to know the terminology. Every profession has its secret handshakes, and real estate investing is no different. So you need to know what these terms mean and how they're used. If you've accomplished that much, you've really gone more than halfway to getting it done. And then, Josh, to answer your question about presentations and whatnot, that falls right in with the same thing. If you make a good presentation, you're saying to the world being the guy on the other side of the transaction, the seller if you're the buyer, or the buyer if you're the seller. You're saying it to your potential equity partner. You're saying it to the lender. You're saying, I know how this stuff works. Okay? So we can do business because I clearly know how this stuff works. Let me give you a silly example, but it's one that I think goes to the point. Very often when I ask my students at Columbia, I give them a case study. I say, here's the facts, okay? Work up a pro forma, do an analysis, but you're not allowed to use my company's software. Okay? You got to do it on your own. Let's see what you come up with. So one of the things that I invariably see is that there is no linear logic to the presentation. Things are all over the place. Okay? You don't go from expenses to from income to expenses, debt service, to cash flow and so on. Things are all over the place. As if I were, a lender or I were an equity partner, I would be asking, what are you trying to tell me? But the one that I find the most amusing is that they will do one of these spreadsheets and all of the numbers. I mean, I'll give them this $15 million property to analyze. Okay, and all of the dollar amounts have decimal points and cents. And I try to say to them in my most serious professorial voice, if this deal doesn't make sense at $15 million, it certainly doesn't make sense at $15 million and 27 cents.
Yep.
It would stop with the distractions. Okay? no investor looks at the loose change. You're announcing to the world, I never did this before. This is my first shot. Okay? So, give me the $15 million, but don't forget my 27 cents. Presentation matters. And it gets back to what I said earlier on the subject of clarity. You've got to get your message across because you have an audience that you're talking to when you make a real estate investment presentation. And you have to address that audience. You have to convey the information so that they can understand it and so that they can see your point of view. You might be the seller trying to talk to the buyer. You might be the buyer trying to convince the seller that his price is wrong. But whatever it is, understand that clarity really matters.
That's great. That's great. Hey, really quick, I heard you plugging that software of yours, and anybody listening could find out how to get there through the show notes again at biggerpockets.com/show4. And of course, they can find a link to pick up a copy of that book of yours amongst the other books as well.
You can spell realdata.com, can finally figure out the software.
Realdata.com. Is that REALDATA.com, Frank?
You spelled it perfectly.
Thank Unbelievable. You. It's amazing. They let me do this show. So we're kind of running out of time here. Before we go, let's talk about a couple really quick questions that I've got for you. One of them is, what is your best piece of advice for new investors?
Do your homework. Okay? That starts with learning the terminology, as I mentioned before. But then when you get out of your book, out of your classroom, as it were, virtual or otherwise, then do your homework about your market and about the properties that you're looking at. There is no substitute for due diligence. And due diligence is not just about the property, even though that's essential, but it's also about the market in which the property lives. You need to know if employers are moving in or moving out. You need to know if cap rates are going up or going down and what they are currently. You need to know what is the typical vacancy rate for properties such as the one that you're looking at. So due diligence is absolutely essential. If you start off by learning the terminology and then learning your market and finally learning your property, then you're following the food chain just perfectly.
That's great. Very, very, very good advice. All right. What is your favorite real estate book? And no, you cannot plug your own book, Frank.
No, I'm being perfectly serious because I wouldn't want to have an idea that got imprinted on my brain, which I then put in one of my books, and then I end up being one of these plagiarism kind of guys. So I try to avoid trying to read other people's stuff because they may have an undue influence subconsciously on me. But there are other good real estate books out there. I have no doubt about that. I just try not to indulge.
That's a fair question. All right. What about business books? What's your favorite business book? And don't give me that same BS answer, Frank.
I guess the one I enjoyed the most is The Big Short. When I was trying to figure out just how we got into the mess that we're in. I believe it's Michael Lewis, if I'm not mistaken. The Big Short was a very interesting expose, if you will, on how we got into the subprime mortgage mess and how that all played out.
All right, so I got a question, Frank. You've been around the industry for a long time. I'm not making fun of your age here; it's just true. So I'm wondering, what have you seen? What sets apart the top performers in our industry? The guys that are really crushing it and doing well and making a future for themselves. What sets them apart from the people who come and go, and the students maybe you've seen in your class that just jump in for a few minutes and then leave, or try their hand one time and it's not for them? What sets those people apart, the top performers?
I hate to be sounding like the proverbial broken record here, but it gets back to my answer to Josh's original question. I think it gets back to education, to taking the time and the trouble to learn how this stuff really works. Not to assume that there are some magic answers. There's some a magic wand and some little dust that you can sprinkle on a deal and you'll immediately finds that, oh, everything's worth 7 times its gross income, a kind of simplicity. But people who take the time and the trouble to actually learn this business, the way you would learn any other profession, those are the ones, I think, who have the leg up. Similarly, those who take the trouble to understand that even if they understand it, if they understand the property and how it works, that they don't live in a vacuum. They do have to deal with other people, buyers, sellers, equity investors, lenders, partners, all this sort of thing. And in order to do that, they have to really work at the other part of my previous answer to Josh's question, the issue of clarity, of being able to make their point of view understood, to understand who their audience is and what it is they're trying to say. The people who take the time to do this, to learn how it really works, then to analyze the property and to make an effective presentation to a third party where that presentation is geared to the interests of the third party. A lender is concerned about certain things. An equity partner might be concerned about some other things. So understanding where it is you're going, understanding your objectives in making the deal and trying to put the deal together, that's what sets the winners apart from the losers, I think.
Oh, that's great. That's great. Hey, Frank, what do you do for fun, man? I'm sure you've got a hobby other than writing books, or do you just sit and write books all day?
That's mostly what I do, but for a really good time, I sit around and I wait for you to call. And I'm so glad you did today. You just made my whole day, guys.
No, seriously.
I'd like to get out on a bicycle and just ride and not have my cell phone turned off and not have anybody call me, not even you, Josh.
That's great.
And if there's anything else, I'd love to play with my grandkids.
Oh, that's great. That's great. Hey, so listen, this was fantastic. I think we've covered a ton of really, really good information here and really just starting to explore a lot of these topics. And of course, listeners can follow you online. I'm assuming you have like Twitter and Facebook accounts and all that stuff. Do you want to share any of that or not?
Yeah, all that good stuff. You can find me on LinkedIn. You can find me on Twitter. We've got a Facebook thing. I'll be honest with you, I don't pay as much attention to that one as I should. But I probably encounter more people on LinkedIn. Just look me up by my name, and you'll find me there.
Of course, Frank is also on BiggerPockets, where he answers questions on our forums at biggerpockets.com/forums. And again, you can find out anything about today's show. We're going to have links to Frank's various social profiles, to his website, to his books, and to some of the concepts and terms and things that we've talked about today at biggerpockets.com/show4. Frank, thank you so much for coming on the show. We really appreciate it. And I know I'm very much looking forward to having you on once again in the future.
Thanks, guys. It's been a pleasure. I really enjoyed it.
Yeah, thank you, Frank.
Hey, everyone. That was our show with best-selling author Frank Gallinelli. We really, really hope that you guys learned a lot about commercial real estate today, and hopefully you'll end up using it to build wealth for your future. Of course, come check out the show notes at www.biggerpockets.com/show4 and leave us or Frank a comment. Also, of course, if you haven't yet signed up for a free BiggerPockets.com membership, you can do that at www.biggerpockets.com. And finally, please do not forget to leave us a review in iTunes. This is really important, guys. It helps us get more visibility for the show. So definitely be sure to check it out and leave us a review over at iTunes. Of course, if you found the show helpful, make sure to also subscribe to the show on iTunes as well. Finally, come check us out on Facebook at facebook.com/biggerpockets. This is Josh Dorkin signing off.
You're listening to Bigger Pockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.